So we'll get going. Welcome everybody. Glad you're joining us tonight. Tonight's topic is insurance. My name is Maria Young, and we've been through several sessions of these together. Marcus Reed, who you know, and Jason Jordan. Jason is here tonight. He's our insurance expert from Ross & Associates, which is an insurance firm here in town. And Jason specializes in a product specifically tailored to brewers. So before we dive into the content, I want to give Jason a chance to tell a little bit about that package and what's different from insurance packages that just a general business might have.
Yeah, so basically I've been focusing on this industry for about 5 years, and I've actually helped carriers do all the white paper research and develop the programs to include specific coverages for the brewery aspect. And it's an interesting combination because you've got a lot of risk involved with manufacturing and preparation and on-site consumption of liquor, all kind of wrapped into one business. So it helps revenue streams and ways that the insurance gets rated, which a lot of agents aren't really up on as far as that aspect of it goes. The coverages that are most unique involved are for the equipment, equipment breakdown, lost product recall, and of course liquor liability, and then there's some optional coverages that we'll kind of dig into a little more once we go along. For the most part, it's a little bit about the product, and it's kind of a lot more about the person that you're dealing with that's selling the product, because there's a lot of nuances and things that a lot of people just don't realize, even insurance agents.
So important to scope out the right insurance agent who's knowledgeable about that industry.
Yeah, that's the biggest factor that I've come across in handling it in the last 5 years.
Yeah, nice. So
Jason's going to talk about this a little bit, but he helps out with your brewery bond as well. And I'm guessing that a lot of agents, if you ask them about a brewery bond, they're going to ask you, what is that? So if you have somebody who has some specific expertise in that area, they're going to be more helpful in that, I would think.
So that would be a good litmus test, is to ask your potential agent about a brewery bond, and if they look at you with that glazed over look, then run or go find somebody else. So we'll dive into the content, start going through the slides. We've got several topics to cover in terms of insurance for breweries, and specifically what you should be thinking about with your startup company. Jason, a lot of items on the list here. Why don't we just start going through these, and you can tell us a little bit about each one.
Yeah, so we'll start off with the brewer's bonds. And it's going to depend a lot. Everybody's going to be under the federal jurisdiction for the TTB, so that process is actually fairly simple. You're really looking at most small to medium-sized breweries, let's say 5,000 barrels a year annually and under, are probably going to be looking at the same taxable bond rate limit, which is a $1,000 limit on a bond, and those are basically instant issue. There's no approval process. There's no credit check. It's just, you really just have to have a business name and a pulse, and it's that easy. It's just a matter of obviously filling out the bond form correctly, because that can create havoc if you don't do it correctly, or the agent doesn't do it properly, and you send it off to be uploaded to TTB, and then you're just going through a back and forth process of doing writers and corrections, which can add weeks to months onto the process, the approval process.
So do you think that people are just starting up and maybe getting into this for the first time? Is there some sort of like online template up to see what kind of information they need to have in order to do it correctly? Or
Yeah, there is. The TTV website is a good resource, and it has the actual, the bond form, and they have samples that have already been filled out and completed.
That's great.
So it gives you all the information you would need. But again, it kind of comes down to finding the right person and agent that will tell you what you need, which would make it a little easier.
Mm-hmm.
But as far as pricing goes, you're looking at it's a 4-year bond. The nice thing is you issue it once and you don't deal with it until 4 years down the road. And you're looking at like $325 on a 4-year bond with a $1,000 limit.
Okay.
It will. I've never had this happen yet, but it obviously can be adjusted based on your production. 2-3 years down the road. If you increase quite a bit, they could come back and request a higher limit at that time.
They in the TTB.
TTB.
Oh, wow.
Same thing with the state, which we can get into as well, but each state's going to be different. Where Oregon has, the same requirement, but they only allow you to issue an annual bond, so you got to issue it every year.
Mm-hmm.
And
now, when that renewal point comes up, should brewers expect that their insurance will prompt them when it's going to expire, or is this something that they have on their personal calendar to be sure to?
They'll be prompted by the actual agent and the surety carrier 90 days in advance.
Okay.
So 3 months out, they'll get an actual notice and more than likely an invoice to renew.
Janine mentioned last week that a good time to evaluate your bond coverage is when you're purchasing additional equipment or undergoing some kind of large expansion that might push you into a different threshold.
Right, exactly. Increasing the size of your system, getting more fermentation vessels, things that would increase production, expanding, adding locations. Definitely adding locations because each location typically has to have its own bonding capacity if there's production going on at more than one location, state and federal.
Jason, what's the difference in the process for getting a bond for a winery or cidery or meadery or a distilled spirits plant?
Good question. Distilled spirits is very complicated. Much though that I'm still trying to figure it out. I don't have enough distillery clients in my portfolio yet to have a lot of experience with it, but I've talked to some distillery owners that they're dealing with this thing like every 3 months, and so I don't know all the hot buttons with that for that specific industry, but I know for cideries, meaderies, and wineries, they're all pretty much classified under the same winery bond. And it's a similar product, just a little different bond form for industries.
Is there any resource you might recommend for state guidance on the bond process? Is there any sort of clearinghouse that folks could turn to see, process and regulation broken out by state?
Yeah, that's a good question. I haven't come across any type of clearinghouse like that. It's always just been state-specific at this point.
Yeah. Wishful thinking, probably.
Yeah.
I think every state beverage control has some kind of page devoted to that.
Yeah. So if you go to that liquor commission for that state, that's where you're going to find it. It seems like with the way the industry's grown, that there would be something like that available here already, if not in the near future.
Great. And then the renovation and build-out phase, it has its own set of considerations as well for insurance needs.
Yeah, so this phase gets a little tricky. Insurance carriers get a little bit gun shy and reluctant to issue insurance for a space that's going to undergo considerable renovations, be it the vacancy factor and just no revenue being produced at that time. So again, this comes back to dealing with a carrier program that realizes what you're going through and already has the capacity and ability to write new ventures and new startups in these industries. But a lot of it's going to depend on your arrangement with your landlord, who's going to be responsible for what as far as the build out goes. Who's hiring the general contractor, who's monitoring the subs. But for the most part, you have to have the cart before the horse because of the liquor commission anyway. So the liquor liability has to be issued before you can get your license approved. So you're already, paying for a license that you can't generate any revenue on or produce any beer or wine or cider until weeks or months down the road.
So I just heard you mention that some of the nuances of this area depend on who's hiring the contractor. So is that to imply that if you are leasing a space and the owner of the building is managing the TIs, that the owner of the building would be the one getting the insurance on that? Or does that mean that if the brewer themselves or tenant is managing the TIs, that they would get the insurance? Is that how that works?
Yeah, it would probably be in the best interest. Usually you're looking at the landlord that's going to have, it's going to come down to who has the contract with the contractor. It's going to dictate who needs to get the certificate of insurance and, you know, be added an additional insured on their policy and make sure they have workers' comp. But yeah, that's going to depend on who has the contract with that contractor doing the movement.
Okay.
Can you discuss the concept of adding a party as an additional insured, how you go about that and what the reasons are for that?
Yeah, you bet. So just jumping a little bit ahead of the screens, but it's a risk transfer mechanism that will enable the contractor's insurance carrier to defend you, the brewer tenant or the landlord, on their policy if something arises out of the work that they do that causes bodily injury, property damage while the project's going on. So otherwise, it's going to be your insurance carrier that's, you're going to have to file a claim and set up defense costs and incur a loss on your record policy if you don't have that additional insurance enforcement. It's a tender of defense, if you will, that they grant because you can't control everything that's going on. You don't want to be liable for damages that another entity or party causes while working on your space. Be it in consideration of where you are the building owner. So in that case, obviously, you're controlling everything.
Okay. And then talk us through this grand opening bullet point. What are the unique considerations there?
The grand opening, so that basically kind of gets you ready for all of your equipment being on premise, everything being installed, and depending on how long the process takes from executing the lease to opening your doors for business, you might want to scale into your policy to where you're not, you know, putting everything on as far as all of your equipment and property values, and because a lot of it you're not going to have in there for several months if the build-out process takes a while. So that's kind of more having the agent go through everything that covers the fire insurance, and then adding on those things that relate to employees and having the general public on the premise at that time.
I didn't realize that phasing into an insurance policy was an option. That's really an interesting.
Yeah, it is, and a lot of people want to go the route of, they just want to keep their costs down, and that's a good way to do it. A lot of agents won't go through the trouble to do that because it's extra work on their behalf to have to make all those changes as opposed to just issuing it with everything on there out of the gate. And so I've found, that's one thing that I do and I counsel people on, and it's benefited some openings.
That's another great piece of advice for people who are starting out, is things to look for in their insurance agent.
Yeah. One myth that's out there that I run into a lot is with liquor liability. You just need the TTB doesn't require any insurance, so you're not under any jurisdiction with them on liability insurance or liquor liability. Your state will have that requirement, and it's usually just liquor liability. And for instance, Oregon requires $300,000 limit of liquor liability. You can't. It's not cost effective to just issue a liquor liability policy on its own. It's actually more expensive to go that route than it is to write the whole package at the time you need the liquor liability.
Interesting.
So I have a hard time, having people get over that myth of not wanting to spend this money. In reality, it's the programs that are available, they don't just offer monoline standalone liquor liability.
Mm-hmm.
So you have to go to an outside brokerage and a higher risk carrier that obviously has higher pricing and higher rates.
Right, because it's always going to be a balance between risk and coverage.
Yeah. So that's, on the grand opening, and obviously we go into employees, which is part of that. A lot of brewery startups end up not having employees for 6 months to a year, to some go 2 years. Just kind of depends on your facility and your business model. Obviously, if you have a tap room and brew pub, that's going to dictate, how soon you have employees. But you've got to deal with workers' comp, obviously, and have that set up prior to running payroll and hiring and having people work for a wage to cover their, if anything happens to them medically, lost wages and medical bills.
And can you clarify, is workers' comp, is that a law or is that a best practice?
Yeah, that's a state law. Oregon statutory limit must carry 500,000 employer's liability for disease, sickness, and death for job-related injuries.
So they should check individual states.
Yeah, check individual states.
Okay.
And it operates differently in different states, right?
Yeah.
Sometimes there's a state-run program for workers' comp. Other times it's through private insurers.
Yeah.
Sometimes hybrid of the two.
Good point, Marcus. Washington is actually a state fund, where they're a monopolistic workers' comp state where you go through them and through their Bureau of Labor and Industries for your coverage. It's a whole different system program. Oregon is actually a model state in the country when it comes to workers' comp, as far as rates and pricing and effectiveness and execution of the actual policy, and then SAFE has kind of been behind that.
Yeah, so if you're wondering what we're talking about, SAFE is SAIF, and is it a public-private enterprise?
Yeah.
It's a public-private business that offers workers' comp, that a lot of people choose to get their workers' comp policies through. So if you're interested, you can poke around on the web for that.
Yeah, and then another coverage that comes into play that kind of relates to employees, but isn't covered by general liability or workers' comp, and I'm kind of just going into the next other coverage to consider here, is employment practices liability insurance, and this is for your hiring and firing practices, wrongful termination, discrimination, harassment, anything that relates to an employee filing a claim or suit that would be against the employer for not getting hired for one reason or getting let go for another reason. They felt wasn't fair.
Is there a rule of thumb on how many employees you have that you should consider getting EPL insurance?
Well, it only takes one employee to a pretty significant claim, but I mean, typically you see around 4 to 5 employees is kind of the point. I always recommend having it regardless of the number of employees, because it's based off of and rated off of how many employees you have. So if you have 1 employee or 10, it's going to be proportionate to how many you have as far as what you pay. And it's actually pretty affordable.
And in terms of pricing, and we might be getting to something that will come in a later slide, but in terms of pricing, is there any guidance that you might be able to offer on how brewers can estimate the price of their insurance? For example, for production, is it based off of production, or is it based, the EPL is based off of the number of employees, or what kind of benchmarks could you provide that helps folks get a handle on the dollars and cents that might be attached to their insurance policy?
Yeah, that's a good question. It's something that I do all the time. That's kind of where I shine, is being able to, without submitting an application and going through the whole underwriting process, I can look at somebody's business plan, which is a great thing to have, by the way, if you're looking to get a good price on insurance and insured with a good program. as well as, experience and whatnot as far as home brewing. But yeah, production is one aspect that has a different rate, and you can break it down by kegs, cans, and bottles. So those elements all have a different rate. I believe bottles being the highest, and then cans and kegs. And it's actually a really minimal rate as far as liability. You're talking like 90 cents on every $1,000 of revenue.
Wow.
It's kind of a general.
Oh, so it goes off revenue.
Yeah.
That's interesting.
Revenue.
Okay.
Yeah. So not barrelage, not. Well, cideries cidery does go off again. Cideries and wineries go off of gallons.
Oh, interesting. That's really. I wonder why that difference is.
Yeah, I think a lot of it is some of the insurance carriers haven't really figured out the correct way to do it, so they're just doing it the way they've always done it. There hasn't been a lot of change. But then most of your premium is going to be in your equipment and your property. So if you got a good idea of what size of system you're going to have and how much it's going to cost, and then all the ancillary equipment you're going to have around that, I know the values and the rates on those and on that aspect. And then your liability is going to be, related to how much sales you're going to generate through your own establishment. There's going to be a separate rate for that.
Jason, we have a question. Eric is asking, can you repeat the figure for insurance based on revenue?
Okay, yeah. So for manufacturing wholesale for beer, you're looking at around a 90-cent rate on every $1,000 of revenue. Or that would be for. I've got the numbers, and I don't have them all memorized as far as cans and bottles and kegs. There's a couple different carriers now have a little bit different rates, but it ranges from like $1.50 to 60 cents.
And what kind of documentation do you have to provide to the insurer for the basis for the rate, and what kind of documentation on the amount and type of equipment that you have?
Another good question. You just pull those numbers out of the air and write them on an application. Literally, there's no substantiation. It's nice to look at like invoices and you and the agent go in depth on figuring out these numbers, because it will have an impact if you don't have the right value on fire insurance and you have a loss. Or the only issue you could have on revenue is you get audited in 12 months. You have additional premium or you can have it credited back if you're overestimated.
You generally don't have to provide financial reports. So.
No. Yeah.
And do you have a ballpark for cider rates? White is asking.
Okay. Yeah. Cider rates are a little bit off gallons. The last one that I've seen, I don't have as much data to kind of confirm this, but I can definitely look it up for sure. I think you're in the neighborhood of about $1.75. I want to say it's. I think that's gallons, or if they actually break that into K.
Don't quote them on that.
Let's see. Can you give us a rough estimate for liquor liability insurance on a brew pub or tap room relative to serving capacity or revenue?
Yeah, relative to revenue, I can give you a good estimate. You're looking at liquor liability rates of about $3 every 1,000 for a tap room. And so let's distinguish a tap room from a brew pub.
Yeah.
It's going to have the food element, so you can have a different rate for restaurant sales with alcohol service. It's going to be one rate and code, and then you're going to have a separate code that's just going to be for liquor. And so they break that out in two ways for the brew pub, and then the tap room is just going to have obviously the liquor code. So the brew pub is actually going to be a little bit more expensive from an insurance perspective than the tap room.
Mm-hmm.
But a lot of insurance carriers don't like or aren't real fond of tap room only with no food.
That makes sense. So you open yourself up to more potential risk by not giving people something to eat along with their
Yeah,
alcohol.
yeah, and the rates are going to be the same. It might limit your options on carriers that will want to write that type of.
Can we talk about carriers for a second? And can you give us some information on how many carriers out there provide this type of insurance? And is it kind of a narrow field, or are there plenty of them out there? How rare is it?
Yeah, it kind of depends on the region you're in. You know, Midwest, East, Northeast, Southwest, Northwest. They're going to have a little bit of a different. There's some regional carriers that don't play in all those territories, but for the most part, you're going to have at least 2 solid carriers, be it national or regional, that have brewery-specific programs with all the coverages designed specifically for that industry.
Mm-hmm. So there will always, or most of the time, there will be an option. You're not locked into one.
Yeah, you'll find a couple, a handful, and then it's just a matter of finding the right agent that has access to or is actually appointed with.
So an agent has to be appointed to a specific carrier.
Yeah.
Okay. And so can one agent represent multiple carriers of that type of insurance?
Yeah. That would be, so you'd be looking for an independent agent, is what they call it, that's appointed with several carriers.
Okay.
And you work with several carriers who actually have craft brewing programs, right?
Yeah.
Multiple carriers.
Yeah, I've got 3 that have specialized programs, 2 that I helped basically roll out and implement and do the white paper research on, and one that's a national carrier actually that anybody could, get appointed with. I mean, they typically don't just appoint anyone. They want to know that they're dealing with somebody that specializes in what they do.
Sure.
That have expertise, because they don't want to saturate a region with 40 agents that 10 of them specialize in this and ones don't. Competing.
And that's a way to protect their brand as well.
Yeah. They find value in that.
Okay.
And go back a step, Jason, you were talking about the rates and how much some of these coverages cost. And you might be talking about this later in your presentation, but rates or coverage is often determined by the lease that you're getting into or by a contract that you're getting into. It's going to tell you how much liability coverage you have to have,
right?
Sometimes how much liquor liability that your landlord will have, a certain amount of liquor liability coverage.
Yeah.
How can these folks determine how much coverage they should have and how much they should negotiate into that lease up
That's a great
front?
question.
Because I've worked with you on accounts before where we get these really unreasonable requests from landlords asking for ridiculous amounts of coverage, and we have to negotiate that down. But sometimes it's difficult to determine just how much that coverage should be. So what's your rule on that?
Yeah, it's that is $1 million question. I mean, when I first got into this industry, my predecessors would tell me, well, you just tell them, they have to have enough insurance before they want to start paying out on a claim. But I mean, that's really not a good answer. I mean, with you see the average responsible limit for liability insurance, public liability for property damage and bodily injury to a third party is $1 million each occurrence with general advocate. And that's, I mean, it's peanuts as far as pricing goes on what you would pay for that versus $500,000 each occurrence and $1 million general advocate. Twice the coverage, and you're literally talking maybe 5% overall on your total cost more.
Do those limits vary according to what part of the country you're in, whether you're in the city or in the country, small town? Those factors.
Yeah, they don't carry insurance out in the country, so no, it's really not. It's not territory specific. It's going to come down to the landlord, and then it's all about working with your agent. And then actually not just working with your agent, but having your agent working with your attorney and your real estate broker. And you got those two people working together, you're going to have things get done that a lot of times not otherwise happen.
And that feeds right into this next comment we have about Tom recommends sending your lease to your insurance agent so they can read it.
Absolutely.
Yeah.
Oh, yeah.
Every time I review it,
That's-
I send it to an insurance agent, which is
Yeah,
this guy
yeah.
actually.
Because you're going to have, sorry to interrupt, there's going to be a lot of things buried in there that get right down to plate glass coverage on all the storefront windows. And just little things that we need to account for and make sure we're not going overboard on things, because these contracts come through with, they're asking for $5 million buying single limit on liability.
On a 6,000 square foot
Yeah.
premises.
Yeah, and I've got, clients that produce, 20 to 40,000 barrels a year, and they don't have that high limits. So, you just gotta work with these people, and usually it comes out good on the other end.
So let's walk through the underwriting process. You want to go to some of these points?
Yeah, so I think the biggest thing is when you're ready to start the process of submitting an application and working with somebody on securing some insurance proposals, there's going to be a brewery-specific supplemental application. And it's pretty extensive. It's, it can be 4 to 5 pages, but it's all relative question on, the control and dispensing of liquor from employees to training. I think the biggest thing is some things that you need to kind of focus on and be aware of is that if you have if you're milling your own grain, they like to see an isolated area that's partitioned off and not just, you're not just milling grain out in the open for all the dust to kind of get everywhere. And,
Oh, that's interesting.
So that's one thing that we run into a lot, that some people, have already, not had that in place, and then it becomes an issue. And then to go one step further with the grain rooms, a lot of carriers would like to see combustible, explosion-proof circuitry and electricity and lighting.
Wow.
So that's one thing that's good.
So not only do you need to have your insurance agent look over your lease, you also need to have your insurance agent in the loop if there are any major upgrades.
Right, yeah, it's nice to get them involved in the build-out phase beforehand, so you can build those into your costs and budget and plan.
Yeah.
That's
why you have a grinder, not a mill, says Eric.
There you go.
And so, let's see, I think obviously business plans are huge. I've worked on several accounts that they don't have a business plan, and they've got they call it a resume, but it's really, it comes, it's a huge benefit from an underwriting perspective when the carrier is looking at the account to see that.
Does that have to play into the theory that, the riskier the brewer or the person who's opening the entity seems, then that's going to, raise the red flag a little higher with the carrier? So they want to see somebody who looks like they've got their stuff together and that they're, conservative in nature, and that the risk profile of the business owner is low. Does that come into play at all?
Yeah, it's the, they look at the failure rate, and they don't have a lot of actuarial data on like breweries and brew pubs. And unfortunately, the carriers are in this little box, and they're looking at a risk, and they don't realize that brew pubs are not like restaurants. They're looking at like a restaurant that has a failure rate of, 5 years before you make a profit. So that's exactly what we're looking at.
They're looking at it more as a credit risk than as a safety.
Yeah, more as a credit risk, where they're going to write the coverage, and then 2 years down the road they're going to be gone and fail, and
It's really interesting as a startup. You see this time and again how these key components that you need for your foundation, you're judged against personal character, because as a startup, that's pretty much what you have to go on. And then, so you're really putting your personal reputation out there to be judged by other professionals. It's kind of a daunting concept.
Yeah, it is. Another thing is with most of these program-driven products for breweries, you're going to have an actual loss control inspector that is going to be representative of the carrier that will either do a pre or most times post inspection. It's nice to bring them in early, which is what I like to do, and have a three-way inspection and go over all the hot buttons before because what will happen, you'll be all set up, we'll open, and in 2 months they'll call you and schedule the inspection, and they'll come out and they'll write up a report. And if there's something on that report that they want you to comply with, you got to do it.
Wow.
And it could be major, it could be minor, it could be costly, it could be, horrible, but they're going to want you to check off those things recommended.
Interesting.
Some of them reflect on, but some of them, if you don't do it, then come renewal, you might
have to
renewal notice.
Find a new carrier.
Yeah, I want you to find a new carrier.
What should a company do if they apply for insurance through a certain company and they're denied? Should they just start surfing around for various different companies, or should they be more proactive in how they present their company?
Yeah, that's a good question, because what can happen is if you have an agent that doesn't present your account right to the carrier, hence asking all the right questions, getting all the right information, you get declined from that carrier, that blocks that option, and you can't now go to an agent and have them try to resurrect it. The damage has already been done.
So you're tainted for that carrier, but
Yeah.
are you tainted for other carriers as well?
No
precedent.
You can approach another carrier, and at that point it's probably a good time to ask the agent, what their options he's working on. And oftentimes you want to maybe get a list of carriers, because if you have multiple agents going to one carrier, you're going to end up muddying the water so much that they only allow one agent to work with one carrier at a time. And if you get 3 applications going on carrier and they're all different, they're going to just kind of throw their hands up in the air and say, I don't think we want to move forward on this.
Yeah, I have a question about that, actually. So there's this concept of an agent of record, I think it's called. So in the company, basically you have an agent of record for a specific carrier, and you can only have one agent of record. But I've always been a little unsure of what exactly that means and if it's binding in any way. And so can you just talk about the agent of record concept and what that means to business owners and how they might be tied down to one person or not?
Yeah, so the agent of record is nice because it gives the insured, the client, the opportunity to switch agents right in the middle of the process if they feel that they're not getting one with service or pension or whatever, and they have an issue or a personality conflict or whatever. They can actually sign the agent of record letter, and it will transfer over the quote. In most cases, usually it's a policy an issue, but and there is a chance that, depending on the agent, they could go back to that carrier and at least try to correct or shed light on the fact that this wasn't done right out of the gate, and maybe do some damage to them and get them to convince them to change their mind.
Okay.
Yeah. So that, I don't know, does that kind of answer your record question?
It does.
I mean, I know it's a weird concept and people don't like them, but that's why they're there.
Okay. I want to open the floor up for questions from you guys. What questions are on your mind in terms of insurance?
We can keep going while you type, but bear in mind to ask questions throughout the presentation. So,
So, got one question here.
you're brewing on your personal property. How would you recommend making sure to separate business and personal stuff? Recommendations to have your company pay rent to yourself. Thoughts on that?
Okay, so typically, if you're going to be in an accessory dwelling unit, or it's a defined space, technically, if it's going to have a different address, Usually, yeah, I guess the best way to do it is to have it, sort of a like informal lease agreement in place, because a lot of times people have their own vehicle and they'll use it for business. I'm just using a vehicle as an example, it's more common, and have a formal lease agreement in place because the vehicle is insured under the corporation or LLC, if you will, but it's owned individually by that person. So that will make an insurable interest in that car or property that you're covering, and we'll make sure that it's covered if the business exposure happens.
And there are reasons other than insurance to make that separation as well. There are tax reasons, liability reasons.
Yeah.
So whenever you're using an accessory dwelling unit, you should just go ahead and create that separation.
Mm-hmm.
You should have a business entity anyway that's going to keep it separate from your personal assets. So you might as well just go ahead and complete that circle with the lease between you as the homeowner and your company as the tenant to the accessory unit.
Yeah, and I would recommend, like, if you're using it in a business, I mean, that's when you need to insure it on the business policy. And that's if you're using it at all. You have your own pilot system and you're using it to, experiment and formulate recipes. But you have another system you actually, use for production. I mean, you need to have it on the business. It's cheap, not part of the pricing.
Before we get too far behind here, Eric had a question, ballpark equation for estimating barrel capacity, etc.
We touched on this a little bit earlier in terms of a brewery. The estimation for your insurance expense would be off of revenues, yeah?
Yeah, if the question is for how much insurance would you pay based on barrel capacity, well, it's actually barrel production, annual barrel production. So it's not going to be really gauged off of what size system you have or how much you have on any one given time as far as barrelage. But yeah, it's off of revenue. So you're doing 300,000 in revenue, and that equates to however many barrels they don't gauge it off a barrel off of revenue.
Mm-hmm. Eric, you also mentioned or any other criteria. I think revenue is going to be the key there. And so the rule of thumb that Jason threw out earlier was 90 cents on every $1,000 of revenue per brewery. Or if you're going with a winery, cidery, meadery, that was based off of production. Yeah.
Off of gallons.
Off of gallons.
Yeah.
Does that answer your question?
David asks, in that situation where you're leasing to your own company, would you then have to pay additional income tax on the rent? The answer is yes. You can probably feel this one, Maria.
Yeah, so I mean, if you are renting, if you as an individual are renting to an entity, whether that be a related or unrelated entity, you're going to have to recognize that income, and that'll go on your personal tax return, yes.
But you'll get an offsetting deduction on the business side from the payment of rent, right?
Yes, the rent will reduce your business income. But one thing that I've seen happen before is, say that there's a business that's owned by two people and one person does shop on their site, on their personal residence site. If you pay rent, if the business pays rent to the person who owns the ADU, then the expense, in your back, all right. So I'm not sure where we left off, but one thing that I've seen before is if there's a business owned by two people, one of the owners has an ADU on their property, and the business pays rent for the use of the ADU, and they pay that to the owner who has the property, then the expense, the rent expense, is going to be divvied up between the two parties. So the person who owns the ADU is only going to get the benefit of half of the expense. Kind of a complicated topic, but you sort of get the short end of the stick there. Let's see here. So anyway, the point is, if you're going to go that route, talk to your CPA. Let's see.
Is it legal to brew or distill commercially from your home? That's a big depends answer. It depends on your state, depends on how your home is arranged. In most cases, you're going to have a separate unit for your home that you get license through the state as a with a liquor license, and you're going to have to get your TTB brewer's permit for that space. So you fulfill all the same requirements that you're going to use for a commercial space, but it's just going to happen to be a space that's on your home. And there are a lot of considerations that go into that, such as will your neighborhood association tolerate kind of use, and will the city approve your kind of use? A lot of considerations that go into it, but it can be done. Distilleries, I'm not familiar with the distillery out of the garage, but I'm sure it's been done. Have you guys heard of that being done?
I've not heard of that being done yet, and I'm leaning towards, I don't think we're going to allow that. You know, the breweries, I've got several clients that have it on their home premise. They go through the process that Mark has just outlined.
So the questions so far, anything else you wanted to discuss?
No, I'm just available for further follow-up and any questions. My information's all on the last screen here. I'm highly consultative. I love representing this industry and helping people, develop and start successful brewery businesses. So
Trust me, he could go on for another 3 hours. He's restraining himself right now.
I second that.
it's a little boring after a while. But, all right.
Well, thank you very much, Jason.
Yeah, thank you all. Appreciate it.
Thank you, Jason.
All right.
So now we're going to turn towards wrapping up the course. This is the last live session of the course, and not only of BB404, but of the whole thing in general. So we advised you earlier to come with any questions you've got. Anybody got something for us? We've got about 15 minutes to answer any burning questions.
As we wait for those questions, we can start talking about topics, but feel free to throw your questions out there.
Oh, the program, cash
you go.
flow. Okay, why would you put build out expenses? It's going to be a fixed asset. I know it's an expense. It's not an expense. It's a fixed asset. So it should go on P&L. No, it goes on the balance sheet. Does this get broken out into labor and materials? Or what if it's floated by the landlord or some other terms other than cash? This would be a big outlay. On a similar note, if you finance your brew house, where does that get reported? Depreciation is calculated on a schedule. Boy, oh boy. Eric, come on now. Should we calculate out the first 3 years of cash flow? What's a reasonable level of assumption? Okay. Let me take this one point at a time. Build out expenses, that's going to be a fixed asset, something that's capitalized, it's not expensed. It lives on the balance sheet, not on the profit and loss statement. It is part of your fixed assets, and it's going to go under the line for property, plant, and equipment. As I mentioned in the recorded video this week, property, plant, and equipment is a term that's synonymous with fixed assets. Fixed assets is also synonymous with equipment, so that all means the same thing. Does this get broken out into labor and materials? It does not get broken out into labor and materials. For example, if you have a contractor who's billing you one invoice for materials and one invoice for labor, both of those get capitalized as the price of the build-out. And it's going to be, likely it's going to be tenant improvement. If it's floated by the landlord. So if you mean by floated by the landlord, if you mean if the landlord's paying for it, then that transaction goes on the landlord's books, not the tenant's books. So if you are doing tenant improvements, this is the way it happens. So you've got a building, and one person owns it, one person occupies it, and then when you improve it, in other words, tenant improvements, you decide who is going to own the tenant improvement process. If the owner owns that process, the owner is going to pay all the bills and do all the bookkeeping for that asset, and the owner gets the benefit of having the asset on his or her books. On the other side of the coin, if the tenant pays for the build-out, then the tenant gets the benefit of having the asset on his or her books, as well as the benefit of the depreciation. Okay, and a similar note, if you finance your brew house, where does that get recorded? When you get funds from the bank loan, then, or from an individual loan, they're going to put the funds that you get are a cash inflow on the financing section of the statement of cash flows, and it will become a liability on your balance sheet. Depreciation is on your profit and loss statement. It's down there at the bottom. Should we calculate the first 3 years of cash flow? For your business plan, if I were in your shoes, I would. If I were in your shoes, I would do the first year, month by month, and then years 2 and 3 annually or quarterly. But the more detailed you can get it, the better off you're going to be. Reasonable level of assumption. You're going to have to do a lot of number crunching in terms of your assumptions. One thing that you can do is pull aggregate data, average data from the industry. You can talk to other brewers that have gone through this process and ask them if they would be kind enough to share some information with you. You can take your first year activity and then say, okay, I think my first year activity is going to continue the same path, but will be increased by X percentage. When I'm working with assumptions, I typically do a lot of using percentages to guide where I think my numbers are going to land. So for example, I might say I think my sales are going to increase by X percent every month up until the first 3 years, and then I think it's going to level off. So you're just going to have to spend a lot of time with your spreadsheets. You're going to have to spend a lot of time considering each different line item in your financials. Let's see.
Thank you, Maria. That's I didn't listen to it.
Was that time?
That was.
We have time? No.
Put me on the next one. Jason asked, we never discussed costing. I know it's a complicated topic, but do you have any resources or examples of brewery costing? I have an excellent resource for brewery costing. It's BB401 and BB402. Go through, Melanie will take you through costing in those classes very thorough level. There are also consultants out there that can help with that kind of thing. There are a couple of really good ones in the Portland area. But the PSU program is much cheaper than a consultant. Trust me on that. And then, sorry I missed your question. In the case where there are equal partners putting money in and each owns equity in the business, are SEC filings required? The answer is no. If you are a manager in that business, if you have a controlling, if you're there's some amount of control in that business, you're not going to have to file anything. The sort of policy behind that is you know the risk you're getting into because you're putting yourself in that position. You've built the company, you've developed a business plan. You're not going to rip yourself off is the assumption. Whether you try to rip your business partner off is another thing, but that's decided in the civil courts arena, not SEC arena. And Wyatt asked, for the blending beer and cider is not legal. You have seen a couple of blends popping up lately. Can you think of a way this is legally happening? I'm not aware of it not being legal. It's if you have a certain percentage of grains used in your cider, alcohol that's derived from grains in your cider, it's going to change it into a malt beverage in most cases. But I'm not aware of it being illegal. I suppose the illegal part could be that if you're trying to make cider to blend with beer, making that cider under a brewery license that doesn't allow you to make cider, that could be a problem. I'm not aware of any limitations on blending beer and cider. I don't know if it would taste very good. That could be a factor. But don't quote me. That could be a TTB issue that I'm unaware of. That'd be something I'd have to look into. My question on depreciation was more about how does that get calculated? Is there a standard schedule to use?
There is a standard schedule, and it's called MACRS, Modified Accelerated Cost Recovery System. Depreciation is complicated, and it is definitely beyond the scope of being able to explain in the next 7 minutes. Yes, you can find depreciation schedules, but you're going to need to know the useful life of each asset that you want to depreciate. And then you would need to go and find a specific table that corresponds to that useful life in terms of years. And then you'd have to figure out when did I place this asset in service. Not only that, but what month did I place it in service, because different rules apply. So the answer is yes, there's a table out there, but to try to explain it all would be useless right now.
Maria Stu had a question about the homework assignment this week. We assume that the schedule across an entire full year of production, or that Jan is actually day one of operations, because that might change the schedule slightly in startup, given suggestions on track down costs.
Which number is that?
They just change the dates, like it goes to, the top.
Oh,
Just the month.
Yeah, you can just change the month to whatever month you're starting in. You can adjust it for, it doesn't have to be calendar year necessarily.
so a question from Jason about a standard chart of accounts. Yeah, there's a standard chart of accounts, but I mean, there's typical accounts you're going to see in a brewery to start up, but I don't know of a resource where you could go online and find that information. The best resource is going to be a CPA who's familiar with the industry, because someone who's familiar with the industry will have seen that type of chart of accounts time and again and knows what should be there. Sorry, that's kind of a cop-out answer, but there's not like an online resource that I know of where you can just access a templated chart of accounts.
Stu, to go back to your question, I think we didn't answer the last part of there. Suggestions on how to track down cost per month. Basically, you're going to have to talk to an agent about that. And if you're actually looking at getting started up soon, that's a great thing to do. Give an agent a call and discuss rates and get some kind of estimate for what it's going to cost. Otherwise, you can use sort of the rule of thumb that Jason gave you today. And you might be able to find some information online too about rates, but generally you're just you're going to have to talk to an agent and get an actual quote.
So, Eric, question, so for cash flow pro forma, what would you do? Is this in terms of depreciation, I assume? I suppose if I were in your shoes, I might do straight line depreciation, which is, straight line is a method you can use, but it's, don't think it's GAAP. GAAP is generally accepted practice. So straight line, for the purposes of this exercise, I would probably figure out what life your individual asset has. So on a spreadsheet, you're going to take your spreadsheet, you're going to list out all the individual pieces of equipment that you have, and that's in one column. And then in the second column, you're going to have a column for useful life. And for each individual piece of equipment, you want to list what that useful life will be. Most brewery equipment is about 7-year life. Office equipment is going to be something different. Furniture and fixtures, something different. Tenant improvements, et cetera, et cetera. So you're going to figure out your useful life, and then the straight line approach, basically you take the number of months in the useful life, and that becomes your denominator. The numerator is going to be the cost of each piece of equipment. You divide that, and that's going to be your monthly depreciation figure per piece of equipment, and then you're going to have to sum that for every single piece of equipment, and the total of that becomes your depreciation for the cash flow pro forma.
And Tom did some homework for us. He pulled up the TTB reg on distilling at home. Distilled spirits plants shall not be located in any dwelling house or any yard or enclosure connected with any dwelling house. The question I would have on that is whether if your accessory dwelling unit is not going to be connected to your dwelling house. I guess it says a shed, so that's going to limit you there. So it sounds like no, you cannot do the accessory dwelling unit spirits plant. That's educational to me. I will note that it says on the premise where beer or wine is produced, you can still pull that off. There are a lot of breweries these days that are manufacturing spirits. You just have to make sure that the premises are separated enough to be considered separate. But you know, Dogfish Head is a good example. They have a distilled spirits plant upstairs from their brew pub in Lewis Beach. I think it's still there as far as I know. I'll find out next week when I'm out there. But there are a couple other examples, like Road is making spirits, and I believe their facility is right in the Road pub in Portland.
Let's see. So somebody else, and I can't remember the name, says, couldn't you find the financials of a public brewery and use their chart of accounts? The financials don't include the chart of accounts, so that wouldn't give you the information that you need. Eric, brew house is $100,000 of useful life off 120 months. Yes, you divide that by 120, and that would be your ballpark depreciation per month.
trying to figure out who says they're going to be in Rehoboth Beach the week of July 4th, so we can go grab a beer. Send me an email. I'll be there the entire week of July 4th, and then I'm heading to up to Ocean City, New Jersey, which I am told is a dry town, which I'm very disappointed about. Looks like we're down to 1 more minute, so I don't see any more questions.
We've included on these.
Yeah, feel free to send us questions. Our contact information is just to explain these slides here, the next slides are basically a summary of the course. You'll see all the topics and all the various the videos that we did. Just as a quick summary, if you have any questions on any of this stuff, here is our contact information. Feel free to drop us an email. I'm happy to get back to you.
Thanks, you guys have been a great group. Thanks so much for being part of this.
It's been a pleasure. Cheers.
Good luck.